You're listening to Karl-Mikael Seiding's AI Alter Ego. This podcast is created based on my own writings, primarily from Substack. Sprezza AI focuses on investments in mental, physical, and financial health. Topics range from pure investment cases, which, of course, should never be considered financial advice, to my experiences and advice on training, nutrition, and sleep. If you're interested in more in-depth investing skills, you should check out theinvestingcourse.com. Today we dive into a real-time example of how to apply the TIC RANGer framework to a stock that has been making waves in public safety technology and now increasingly in artificial intelligence, Axon Enterprise, and for contrast and comparison, also super microcomputer. This episode was created with the help of generative AI, my own TIC language model, and an AI text-to-speech model using the PodReader app. We will spend the next 10 minutes or so walking through the fundamental drivers, the valuation context, the future trajectory, and ultimately whether this stock deserves a spot on your watch list or even in your portfolio. Let us start with the company Axon Enterprise. Axon Enterprise, ticker AXON, is best known for tasers and body-worn cameras. In recent years it has evolved. Today, more than 70% of its business is built on recurring revenues, specifically its digital platform evidence.com. This cloud-based service is becoming a critical infrastructure tool for law enforcement agencies worldwide. In the first quarter of 2025, revenues rose 16% year-on-year to $226 million. Earnings per share climbed over 20% to about $4.60 over the trailing 12-month period. Axon guided for full-year 2025 revenue in the range of $910 million to $920 million, with earnings per share expected to grow another 20%. These are not startup numbers. This is a business that has already scaled, yet still shows high double-digit growth. Here we bring in our TIC RANGer toolset. Under RANGer, we begin with revenue. We see consistent 15% annual growth projected through 2029. That would take revenue from $915 million this year to nearly $1.6 billion 4 years from now. Next, we look at earnings per share. Here too, Axon delivers. Earnings per share are expected to grow over 20% per year, rising from $4.60 this year to $11 by 2029. That is powerful compounding, especially given the high-margin nature of the software business. How about the narrative and sentiment? In Axon's case, the narrative is strong. The company is not just selling hardware. It is building a data infrastructure for law enforcement, from smart tasers to AI-enabled real-time video tagging and officer wellness tools. That is sticky, mission-critical technology. This shift to being a platform company justifies the premium multiple the stock currently carries. Here is where most investors will start to panic. Axon is currently trading at a price-to-earnings ratio of roughly 160. That is not a typo, 160 times earnings. Using the RANGer lens, we do not reject high multiples outright. Instead, we ask, can this company grow into that valuation or even grow faster than the market expects? When we project a gradual compression of that price-to-earnings ratio down to 45 by 2029, which would still be rich compared to the market, we arrive at a price target of $495. That is below today's price of $769. But remember, that is only half the story. Axon is expected to generate $37.60 in cumulative earnings per share over the next 4 years. If you add that to the lower-end price target, you still get solid value creation. In fact, I think consensus expectations are underestimating Axon's monetization power in artificial intelligence. However, we cannot be certain that the accumulated earnings per share will add to shareholder value unless they convert into free cash flow, accumulate as net cash, or get distributed as dividends. It may simply be consumed by the company to invest in growth. So how do we reconcile the apparent downside in the share price with the fundamentals that scream strength? Here is the trick. Not every stock with a falling multiple is a bad investment. This is where RANGER shines, because if a company compounds earnings per share at over 20% per year, even steep multiple contraction can be offset. And if that contraction does not fully materialize, then the upside explodes. In my view, Axon has crossed a key threshold. It is no longer just a product company. It is a platform with recurring predictable revenue, scalable technology infrastructure, and international optionality. That means its historical price-to-earnings norms may no longer apply in the same way. That is why, despite the headline valuation, I believe Axon is a stock worth buying today, not with your entire portfolio, but as a high-conviction, long-duration core holding. To summarize, revenue and earnings per share growth are real, persistent, and supported by recurring revenues. The narrative is coherent and increasingly influenced by artificial intelligence. Valuation is high, but the RANGER framework shows it may be justified, and even with multiple compression, total shareholder return can be positive. This is exactly the kind of situation where the TIC framework helps cut through market noise. Instead of reacting to headline price-to-earnings ratios, we ask what is changing structurally in the business, what is the embedded growth rate, and how resilient is the business model. Next time you see a high multiple stock, ask yourself, is it an Axon in disguise? Welcome back to part 2 of this episode of the Investing Course podcast. We will build on our Axon discussion by applying the same TIC RANGER lens to another widely discussed high-growth name, Super Microcomputer, ticker SMCI. This company has been one of the standout beneficiaries of the artificial intelligence infrastructure boom, but when we put it through the RANGER process, the investment picture changes dramatically. Supermicro builds high-performance server and storage systems. It is a key supplier in the AI data center space and often ships platforms used by NVIDIA graphics processing units. On the surface, this is a company riding a hot trend. Revenue has exploded. In 2024, the company generated over $14 billion in revenue, with growth exceeding 100% year-on-year. Earnings per share similarly leap past $22. Its guidance for 2025 suggests continued top-line momentum. Even with strong tailwinds, it is unlikely Supermicro maintains growth of 100% or more. Consensus and our base case suggest a slowdown to 20 to 25% growth in 2025, tapering to about 10% by 2029. That would bring revenue from $14 billion this year to about $22 billion in 4 years. A similar deceleration appears in earnings per share. EPS may grow from $22 to around $35 over the same period, which is a strong absolute gain, but much slower in percentage terms than what is priced in. Supermicro is positioned as a vital AI enabler, but the story lacks the recurring revenue backbone that made Axon so appealing. It sells servers rather than software subscriptions. That means more cyclical exposure and lower revenue visibility. Here is the issue. Supermicro trades at a price-to-earnings ratio of about 65 and a price-to-sales ratio over 5. For a hardware business with cyclical exposure and compressing growth, that is rich. If we forecast a reversion to 25 to 30 times earnings by 2029, fair value lands closer to $875 compared to today's price near $960. Even when including future earnings per share, total shareholder return barely breaks 3% annually, and that assumes no major hiccups. When we compare Supermicro to Axon, we see that Axon is growing earnings per share and revenue in the 15 to 25% range, backed by a high-margin recurring model and platform expansion. Supermicro is growing fast today, but that growth is front-loaded and tied to hardware cycles, making it more valuation-dependent. In short, Axon's multiple may compress, but its business quality justifies a premium. Supermicro's multiple almost has to compress, and its product cycle risk makes it more speculative. So here is where I land. Supermicro is a fascinating short-term momentum story, but structurally weaker as a long-term core holding. Axon, despite the frothy valuation, offers a durable growth engine. If I had to buy and hold one for the next 5 years, it would not be close. That is the power of the RANGER method. It is not just about identifying growth. It is about qualifying that growth narratively, financially, and through market structure. Until next time, stay sharp, stay independent, and keep applying your tools. Feel free to check out reviews of the investing course at theinvestingcourse.com and apply to the next cohort.